Hey everyone, and welcome to the deep dive. Today we're going to be taking a deep dive into the world of investing.
All right.
We're going to be exploring market history and uncovering the strategies that can uh, help you build a solid financial future.
Yeah, that's a great topic. And what I find really fascinating about investing is it's not just, numbers and charts. It's really about human psychology.
Okay.
If you understand how markets have reacted in the past, that can give us some really valuable insights into how they might behave in the future.
Yeah, that makes sense. It's like having a financial crystal ball,
Right.
but instead of gazing into the future, we're kind of looking back at the past
Exactly.
to learn from the mistakes and the triumphs of those who came before us.
Right. And one of the most compelling lessons that we can learn from market history is this recurring phenomenon of market bubbles.
Uh-huh.
Like, remember the Dutch tulip mania?
Oh yeah, I've heard of that.
Well, people were trading their homes for tulip bulbs.
It sounds crazy.
It does, but it highlights a key principle of behavioral economics. This irrational exuberance that people have,
Okay.
where when people get caught up in the hype, they often ignore fundamental valuations,
Yeah.
and it drives prices up to unsustainable levels.
Yeah, yeah. And it's not just a historical anecdote, right?
No.
We've seen this pattern repeat itself time and again, from the South Sea bubble back in the 18th century to the dot-com bubble like the late 1990s and even, the US housing bubble in the early 2000s.
Yeah, all very recent examples.
So speaking of the dot-com bubble, that was a wild ride.
It really
I
was.
mean, everyone was so excited about the potential of the internet that they were pouring money into any company with .com in its name.
Right.
I remember Cisco, even a blue chip company like that, got caught up in all the frenzy.
Yeah, and that's, you brought up a good point. It's a reminder that even, quote unquote, safe investments can become incredibly risky when they're driven by speculation.
Yeah.
When that bubble burst, trillions of dollars just evaporated overnight,
Oh, wow.
left many investors wondering what hit them.
And then there was the U.S. housing bubble.
Right.
That one wasn't just driven by speculation. It was also driven by a combination of government policies, easy credit, and the belief that house prices would just keep going up forever,
Yeah, forever.
which we know is not how it works.
Not how it works. And what's interesting about the housing bubble is, it wasn't just about individual investors making bad decisions. It was a systemic issue.
Okay.
Banks and other financial institutions were packaging these risky mortgages and selling them as safe investments.
Right.
And when those mortgages started to default, it triggered this chain reaction that led to, really the worst financial crisis that we've seen since the Great Depression.
So it's a stark reminder that seemingly safe investments can turn risky
Yes.
when they're driven by factors that are outside of a company's control.
Absolutely. So, what can we learn from all of this? Well, the key takeaway here is that history has a tendency to repeat itself.
Okay.
Understanding these past bubbles can really help us to identify and hopefully avoid similar pitfalls in the future.
That makes sense.
A Random Walk Down Wall Street really delves deeper into these concepts.
Okay.
And it offers, it's kind of a compelling narrative of market history
Yeah.
and how it's relevant for today's investors.
So we've talked about the dangers of these market bubbles and the importance of learning from history. But how do we actually apply these lessons to our own investment decisions? How do we figure out the real value of a company?
Yeah, that's a great question. And that's where this whole debate between fundamental analysis and technical analysis comes in.
Okay.
Fundamental analysis focuses on a company's underlying financials, so its earnings, assets, management quality, industry position.
Right.
It's really about trying to understand the intrinsic value of that business.
So it's like looking under the hood of a car, before you buy it.
Exactly.
Make sure the engine's in good shape, the tires are new, and, it has a good track record of performance.
Exactly right. Make sure it's not a lemon.
Yeah.
Technical analysis, on the other hand, that relies more on charts,
Okay.
patterns, historical price movements to predict future price action. So it's more about trying to identify trends and momentum.
So it's like trying to guess where the car's going based on the tire tracks it left behind.
Yeah, that's a pretty good analogy.
Yeah.
And while technical analysis can be, a useful tool for short-term trading, the evidence really suggests that stock prices tend to follow what we call a random walk in the short term,
Okay.
which means that, past price movements are not necessarily a reliable predictor of future performance.
So trying to time the market based on charts alone
Right.
can be kind of a risky game.
Very risky.
It's like trying to predict the weather, by looking at a crystal ball.
Exactly, exactly. For long-term investors, focusing on a company's fundamentals, its ability to generate consistent earnings growth,
Uh,
that's a much more reliable path to success.
so okay, so let's say we've done our homework, right?
Right.
And we're ready to start building a winning investment strategy.
Okay.
Where do we begin?
Well, one of the most important things that you can do is to diversify your portfolio. Don't put all your eggs in one basket,
Okay.
right? Instead, spread your investments across different asset classes like stocks, bonds, real estate, things like that.
Diversification is key, right?
Diversification is key.
It helps to mitigate risk, helps protect your portfolio from, any kind of market swings.
Right.
But but with so many investment options out there, it could feel a little overwhelming
It can be, yeah.
to know, where to start. What are some practical steps that, our listeners can take to start building a solid portfolio?
Well, one of the simplest and most effective ways to diversify is to invest in something called an index fund. An index fund is a type of mutual fund that tracks a specific market index, like the S&P 500, for example.
Right, right.
Instead of trying to pick individual stocks, you're essentially buying a small piece of the entire market.
So instead of trying to pick the winning team,
Right.
you're investing in the whole league.
You're investing in the whole league, exactly. And because index funds are what we call passively managed, meaning they simply track the underlying index,
Yeah.
they have very, very low fees, which can make a big difference in your returns over the long run.
Okay. Low fees, broad diversification. I mean, index funds, they sound like a pretty good deal.
They can be.
But what about those of us that are a little more adventurous?
Uh-huh.
Want to try our hand at picking individual stocks?
Yeah.
Any advice for the aspiring stock pickers out there?
Yeah, absolutely. If you're going to try your hand at stock picking, it's absolutely crucial to do your research and understand the company that you're investing in.
Okay.
Look beyond the hype, dig into those financials, make sure that company has a solid track record of earnings growth
Yeah.
and a sustainable business model.
It's like dating, all right?
It is a lot like dating.
Don't just go for the flashy exterior.
Yeah,
Right?
yeah.
You gotta get to know the person.
Get to know the person, their values,
Yeah.
their long-term potential.
Exactly.
Right.
Exactly.
And just like in dating, it's important to be patient,
Yeah.
Don't expect to get rich quick.
Right.
Investing is definitely a long-term game.
So we've covered diversification.
Uh-huh.
We've covered index funds.
Yes.
We've covered the basics of stock picking.
Right.
But what about those of us who aren't quite ready to, DIY our entire portfolio?
Yeah.
Is there an option for, those of us who prefer a little more of a hands-off approach?
Absolutely. For those folks who prefer to delegate my investment decisions, hiring a professional financial advisor can be a great option. You just got to make sure to do your research and find an advisor who is, trustworthy,
Right.
who's competent, and who's aligned with your financial goals.
It's like having a personal trainer for your finances.
That's a great way to put it, yeah.
Right. They can help you create a customized plan to stay on track,
Right.
to make adjustments as needed.
Exactly. But even if you hire an advisor, it's still really important to understand the basic principles of investing
Okay.
and know what questions to ask. Knowledge is power.
So, all right. So we got diversification, we got index funds, stock picking, financial advisors.
Right.
Those are some great building blocks for a solid investment strategy.
Yes.
But what are some kind of overarching principles that can guide us throughout our investment journey,
Okay.
regardless of our age or risk tolerance?
Sure. Well, one of the most important principles is this idea of dollar cost averaging.
Okay.
It's a simple yet very powerful strategy. It involves investing a fixed amount of money at regular intervals regardless of market conditions.
So instead of trying to time the market,
Right.
Buy low, sell high,
Exactly.
we're just consistently investing a set amount,
Right.
whether the market's up or down.
Exactly. You got it. By investing consistently, you're buying more shares when prices are low and fewer shares when prices are high, which can really help to lower your average cost per share over time.
Okay.
It's a great way to take the emotion out of investing and build wealth steadily over the long term.
This kind of sounds similar to like the idea of set it and forget it.
Right.
Is this something that can be easily automated?
Absolutely. Most investment platforms these days offer automatic investing features.
Okay.
So you can, set up recurring contributions to your investment accounts.
Right.
It's a super convenient way to stay disciplined and make sure you're consistently investing towards those financial goals.
This all makes a lot of sense. It feels like I'm finally starting to connect the dots,
Yeah.
see the bigger picture of how all of these concepts fit together.
That's great to hear. Remember, investing isn't about getting rich quick, right?
Yeah.
It's about making informed decisions, staying disciplined, and focusing on the long term. And, a random walk down Wall Street really provides a comprehensive overview of these principles,
Yeah.
offering practical advice, historical context to really help you navigate all the complexities of the financial world.
So we've covered a lot of ground in this deep dive into the world of investing,
Yeah, we have.
from market history to fundamental analysis, index funds and the power of dollar cost averaging. I feel like we've explored some really key strategies for building a solid financial future. But before we wrap up, I want to touch on one more important concept, and that is life cycle investing.
Ooh, that's a good one.
What is that all about?
So, life cycle investing is this idea that your investment strategy should evolve as you move through different stages of life.
Okay.
Right. So, when you're younger, you have a longer time horizon,
Right.
which means you can afford to take on more risk.
Okay, so it's like being a tightrope walker.
Okay.
When you're starting out, you can afford to wobble a bit,
Right.
because you have more time to regain your balance.
Exactly. As you get closer to retirement, however, your focus really shifts to preserving capital and generating income.
Okay.
This means you're going to want to gradually shift your portfolio towards more conservative investments like bonds.
So it's like transitioning from the tightrope to a nice stable rocking chair.
Right.
A little less
A
exciting,
little less exciting.
perhaps, but much more comfortable.
Much more comfortable, yes.
and secure.
Exactly. And remember, there's no one-size-fits-all approach to life cycle investing, right?
Right.
Your ideal asset allocation is going to depend on your own individual circumstances, your financial goals, and your risk tolerance.
So to kind of recap our deep dive, what are the key takeaways that we want our listeners to walk away with today?
Sure. I would say one of the biggest ones is that market history is a valuable teacher.
Okay.
Understanding those past bubbles and crashes can really help us to make more informed investment decisions today.
Right.
And in the future, another big one is focusing on the fundamentals, a company's intrinsic value,
Yeah.
and their long-term earning potential. That's key to successful investing. And of course, we can't forget about index funds, which are a fantastic tool for building that diversified portfolio with low fees
Right.
and broad market exposure. And then we've got dollar cost averaging,
Yeah.
which is a really powerful strategy for taking the emotion out of investing,
Okay.
building wealth steadily over time. And then finally, I would say, adjusting your investment strategy as you age. So transitioning from higher risk assets to lower risk assets as you approach retirement.
Right.
That's essential for a successful long-term financial plan.
Yeah, I this deep dive has been so insightful. I feel like I've gained a much clearer understanding of the world of investing and the strategies that can help me achieve, my own financial goals.
Well, I'm so glad to hear that you found it valuable. And just remember that the journey to financial literacy, that's an ongoing process, right?
Right.
Keep learning, keep exploring, and never stop asking questions.
And if you're interested in kind of diving a little deeper into the concepts we've discussed today,
Yeah,
we highly recommend checking out A Random Walk Down Wall Street.
absolutely.
I mean, it's a classic for a reason, offers some really timeless wisdom
Yes,
and practical advice for investors of all levels. So,
absolutely.
all right. Well, with that, we'll wrap up this deep dive. Thanks for joining us on the deep dive.
Yes, thanks for listening, everyone.
Until next time, happy investing.